So, if you have dared to open your trading app anytime in the last 2 weeks, specifically looking at the Indonesian market, you probably felt that very specific, very unpleasant drop in your stomach. You know the one I'm talking
Oh,
about?
yeah.
We aren't just talking about a bad day or, a slight correction. We are talking about the IHSG, the Jakarta Composite Index, going through what can only be described as a historic, absolute meltdown.
It was carnage. There's really no other word for it. I mean, it was a stress test for every single person who had money in the market.
We saw trading halts. We saw double-digit intraday drops. We saw a sea of red that just it wouldn't stop flashing.
Right.
Usually on this show, we like to take a step back and look at trends over months or years. But today, we have to zoom in. We need to look at a period of, what, about 10 days?
Yeah.
Because something fascinating and honestly kind of terrifying happened in that short
It
window.
was a condensed crisis.
Yeah.
And what's interesting is that while the market was, just screaming, there was a very specific group of traders trying to figure out how to keep their heads on straight.
Right. And that brings us to our source for today. We have got our hands on an internal education report from the Red Team trading community.
Mhm.
Now, usually financial reports have these boring titles like Q1 Outlook or Market Analysis. This one grabbed me immediately. It's titled, Calm is Non-Negotiable, Action is Situational.
It's a striking title. And honestly, having read through it, this isn't your standard buy this stock, sell that stock report.
Mm-hmm.
It reads much more like a psychological survival guide for traders operating in a war zone.
That is exactly what I want to unpack. Because let's be real here. When the market is down 7% in a single day, calm feels like the absolute wrong reaction.
It feels impossible.
Calm feels like denial. My brain is screaming, the house is on fire, grab the cat and get out. So what is the red team actually arguing here? Are they saying we should just ignore the fire?
No, not at all.
Hmm.
They are arguing for a specific mental operating system. The core premise is that you have to completely separate your emotional state from your trading decisions.
Hmm.
They use a really powerful analogy in the report that I think perfectly frames this. The surgeon.
Okay, walk me through that. I'm picturing a surgeon, scrubbed in, bright lights.
Right. Picture a surgeon in the operating room.
Okay.
It's a high-stakes procedure. Suddenly, something goes wrong, an artery bursts, the monitors start screaming, blood is everywhere, the patient is dying.
Okay.
Now, in that moment, the situation is objectively terrible. It is dangerous. It is life or death.
Right. It's a crisis. If that were me, I'd probably faint.
Yeah, exactly. But if the surgeon panics, if their heart rate spikes, if their hands start shaking because they are terrified, the patient dies.
Sure.
The surgeon must remain calm. Not because the situation is safe, it isn't, but because calm is the only state in which their skill can function.
I see where you're going. So bringing this back to stocks, when the IHSG drops 600 points, that's the artery bursting.
Precisely. The market crashing is the medical emergency. And what do most retail investors do? They panic, their hands shake, they hit the sell button, not because their strategy says to, but because the pain of losing money is just too high.
Yeah.
The Red Team report argues that calm isn't about sipping coffee and saying this is fine while the room burns. It's about suppressing the biological panic response so you can actually look at the data and use your skills.
So is the difference between reacting and responding?
Yes, exactly. Reaction is biological. It's flight or fight. It's your amygdala hijacking your brain. Response is analytical. It's looking at the catalyst, weighing the options, and making a choice.
Okay, I buy the philosophy. In theory, I want to be the surgeon. But let's test this framework against reality, because it's easy to be philosophical when the market is green.
Of course.
Let's go back to late January 2026. This wasn't just one bad news cycle. It felt like the universe was conspiring against the Indonesian economy.
It was a perfect storm. The report breaks this down chronologically, and when you see it laid out day by day, you understand why the panic was so intense. It wasn't one punch, it was a combo. It starts on January 27th.
The trigger event.
Right. MSCI, the global index provider, drops a bombshell. They announce a freeze on rebalancing Indonesian stocks. And they don't just say, we're pausing.
Yeah.
They attach a severe warning about market transparency.
Just so we are clear on the stakes here, MSCI is the benchmark. If you're a massive global fund in New York or London, you track the MSCI. If they freeze you, you're toxic.
Exactly. It's a massive red flag for institutional money. It signals that the plumbing of the market might be broken. So that news hits. The market opens the next day, January 28th, crash day one.
And what a day. The IHSG plummets 659 points. That is a 7.35% drop in a single session.
Which triggers the trading halt.
Huh.
The exchange literally pulls the plug to stop the bleeding.
But it doesn't work. January 29th, the very next morning, we open and everyone is hoping for a bounce. Instead, we drop another 8% in the first 30 minutes.
At that moment, psychology just takes over.
At that point, if you're watching the screen, you aren't thinking correction, you're thinking collapse. You're thinking 1998 Asian financial crisis. You're thinking...
Is my money gone?
Yeah.
And the headlines kept feeding that fear. Just as the market is reeling, January 30th happens. We get a massive leadership shakeup. The president-director of the Indonesia Stock Exchange, Iman Rahman, resigned.
And others too.
And 4 officials from the OJK, the Financial Services Authority, also resign.
See, that's the one that would have broken me. When the captains abandon the ship in the middle of a storm, how do you interpret that as anything other than run? It looks like they know something we don't.
It looks terrible. And then, just to kick you while you're down, February 5th, Moody's steps in and downgrades Indonesia's outlook from stable to negative.
It's relentless. MSCI freeze, market crash, regulators quitting, credit downgrade. In the fog of war, that looks like the end of the world.
It does. And that is exactly where the red team framework steps in. Report says you have to stop looking at this as one big, monolithic, end-of-the-world event. You have to break it apart.
Okay.
They call it the deep dive method. You have to analyze 3 things for every piece of bad news: severity, time horizon, and nature of impact.
Okay, let's do it. Let's untangle the knots. Let's start with the MSCI knot. That was the main driver. Why was the market so terrified of a freeze?
Well, it's structural. The fear wasn't the freeze itself. The fear was what comes after. If Indonesia doesn't fix these transparency issues by May 2026, MSCI threatened to downgrade Indonesia from an emerging market to a frontier market.
Frontier market. It sounds adventurous, almost cool, but in finance terms, that's a demotion, right? A big one.
It's a massive demotion. It's like getting relegated from the Premier League to the 3rd division. The pool of capital available for frontier markets is tiny compared to emerging markets.
Wow.
If that downgrade happened, global funds would be legally required by their own charters to sell Indonesian stocks. That is a forced exit.
So panic was justified. That sounds catastrophic. If everyone has to sell, the price goes to zero.
The risk is catastrophic. But look at the time horizon. That's the second part of the framework. The deadline is May 2026. We were sitting in late January. The report points out that this is a negotiation, not a sentencing. The BEI and OJK immediately started meetings with MSCI on February 2nd and 5th.
So it's a warning shot. It's fix this or else, not you're fired.
Exactly. It requires monitoring.
Right.
But does it require selling everything at a 15% loss on January 29th? No, because the actual disaster hasn't happened yet, and steps are being taken to prevent it.
Okay, fair enough. What about the resignations? You said earlier that looking at that as captains abandoning ship is an emotional take. What is the analytical take? Because to me, it still looks bad.
The Red Team report corrects this beautifully. They view the resignations not as fleeing, but as a signal of responsibility. It's a political move.
Huh?
The logic is, we messed up the oversight, which led to this MSCI issue, so we are stepping down to show the world we take this seriously.
Okay, I can see that interpretation. But functionally, doesn't it leave a vacuum? Who is driving the bus if everyone quits?
It creates a temporary leadership vacuum, sure, but it doesn't break the plumbing of the market. The trading systems still work. The settlements still happen.
So the machine keeps running.
The report classifies this as a short-term sentiment issue. It's noise. It might last 1 or 2 months. It creates uncertainty, but it isn't a fundamental economic break. The companies listed on the exchange are still selling products and making money.
Got it. Scary headline, but the machine keeps running. Now, the third one, Moody's. They downgraded the outlook to negative. That feels structural. That affects the cost of money, doesn't it?
It does, but we have to be very precise with the language here. Moody's changed the outlook, not the rating.
Help us non-finance nerds here. What is the practical difference? Why should I care about the distinction?
Think of it like a credit card company. A rating downgrade is like your bank dropping your credit score from 750 to 600. Suddenly, your mortgage rate goes up today.
Ouch.
You are immediately a riskier borrower and your cost of living spikes.
Okay, that hurts immediately.
An outlook change is the bank sending you a letter saying, hey, we noticed you missed a payment. We are watching you. If you don't get your act together in 6 to 12 months, then we will drop your score.
So again, it's a warning, it's conditional, it's shape up.
Correct. Indonesia's rating is still bought to investment grade. The report emphasizes that while Moody's cited reduced policy predictability as a valid worry, it hasn't crystallized into a financial penalty yet.
This leads us to the part of the report that I think is the most useful tool for our listeners, the decision matrix.
Yes.
Because understanding the news is one thing, but knowing what to do with your thumb, whether to hit sell or hold, is another. That's where the rubber meets the road.
This is the core of the red team strategy. They break down market events into 4 scenarios. And for each scenario, there is a pre-planned action. The idea is that you decide what to do before the panic hits.
Let's run through them. Scenario 1.
Scenario 1. The catalyst is sentimental or panic-driven. The crowd is scared, but the underlying economics, GDP, corporate earnings are fine. The action is Oldian.
This was the crash on January 28th.
Yes, GDP was still 5.11%, companies were profitable, the selling was pure fear. If you sold then, you gave away value.
Okay. Scenario 2.
Scenario 2. Short-term or limited issues, like the resignations. It's messy, it creates volatility, but it clears up. The action is hold D plus monitor. You watch closely, maybe you don't add new money yet, but you definitely don't flee.
And scenario 3, this is where it gets serious.
Scenario 3. Medium-term or structural issues. This is the Moody's outlook change. There is a real risk that things get worse over the next year. The action here is partial defense.
Define partial defense. Does that mean selling everything?
No. It means you reduce risk. Maybe you sell your weakest positions. Maybe you raise some cash so you have 20% or 30% liquidity. You protect yourself, you secure the perimeter, but you don't exit the market entirely.
And finally, the doomsday scenario. Scenario 4.
Scenario 4 is the convergence of structural failures.
Yeah.
This is if MSCI actually downgraded us to frontier, and Moody's junked the credit rating, and the economy collapsed. That is full defense. You sell everything. You go to cash. You retreat.
The report uses a military analogy here that I really liked. It helped me visualize why I shouldn't panic. They talk about different types of attacks.
It helps visualize it perfectly. They compare panic selling scenario 1 to a guerrilla attack. It's loud, it's chaotic, it's a hit and run. But if you hold your ground, the enemy leaves. You don't need to move.
But if it's an artillery attack?
That's a structural shift. The enemy has your coordinates.
Yeah.
You can't just sit there and hope. You have to relocate to a safer position. That's your partial defense.
So the mistake most people made in late January was treating a guerrilla attack like it was a full-scale invasion.
Exactly. They ran away from a hit and run, and running away is expensive.
Well, let's talk about that expense, because we are recording this on February 10th. We have the benefit of hindsight. Was the red team right? Did the market actually bounce back?
The numbers don't lie. As of today, the IHSG has recovered about 8.7% from the lows of January 29th.
That is a massive bounce in less than 2 weeks.
It is. And think about the trader who panicked. They sold at the absolute bottom on the 29th. They locked in a 15% loss. Now the market is moving up. If they want back in, they have to pay 8% or 10% more than where they sold. They got whipped on the way down, and now they're getting left behind on the way up. That is how you destroy wealth.
There is one specific detail in the report that I think is a Blinkist moment for our listeners. It's about foreign flow. Everyone was screaming that foreigners were dumping Indonesian stocks, and they were. But the report says something nuanced here that blew my mind.
This is a critical insight for anyone interested in emerging markets. Yes, foreign funds sold stocks. We saw that in the daily equity outflow data. It looked like they were fleeing. But, and this is the huge but, the money didn't leave the country.
How on earth do we know that?
We look at the Forex market, the currency. See, if a foreign fund truly wants to exit Indonesia completely, they sell the stock, the rupiah, and then they immediately sell that rupiah to buy US dollars to take home.
And that would tank the currency.
That massive selling of rupiah would crash the currency.
But the rupiah remained relatively stable during the crash.
Exactly. The currency didn't crash in proportion to the stock market. That tells us that the capital was sitting in rupiah, in cash, inside Indonesia.
So they were just sitting on the sidelines.
They were waiting for re-entry. The big players didn't see a collapse. They saw a repricing event. They wanted to buy back in just at lower prices. If you followed the herd and panic sold, you were effectively selling your cheap stocks to these guys who were just waiting to scoop them up.
That is devious and incredibly smart. It's like poker. They bluffed the market. So looking ahead, are we out of the woods, or are there still traps set?
In the market, you're never fully out of the woods. The technicals show the index is fighting resistance at 8,200. We have good support at 7,846, which is the 200-day moving average. But for the listener, there are 2 specific things you need to mark on your calendar.
Okay, pens out. What are we watching?
First, May 2026. That is the MSCI deadline. The clock is ticking. We need to confirm that the regulators have actually satisfied MSCI's transparency requirements. If they do, the risk vanishes. If not, the frontier market threat comes back.
And the second.
It's not a specific date, but a constant watch on Moody's. The government needs to improve what Moody's called policy predictability. If we see stable governance over the next 6 months, that negative outlook could flip back to stable.
So the strategy right now is hold, monitor, and don't let the headlines scare you out of your position.
Precisely. Keep your eye on the structural data, not the daily noise.
You know, there's a quote in the outro of this report that really stuck with me. Next time stocks fall together, remember the IHSG today.
It's an anchor point. The difference between a survivor and a victim in this crash wasn't prediction. Nobody predicted that specific sequence of events on January 26th. You couldn't have. The difference was response. Panic is expensive. Calm is profitable.
It brings up a really provocative thought about what it means to win in trading. The report talks about process over outcome.
This is the thought I want to leave everyone with. Imagine 2 traders. Trader A panicked on January 28th. They sold everything on a hunch because they were scared. Maybe they got lucky. Maybe the market dipped a bit more and they saved a few percent. They feel like a genius.
Society would say Trader A won. They have more cash in their pocket today.
But the red team argues that Trader A actually failed. They reinforced a bad habit panic. They treated a complex system like a casino. Next time, that panic will destroy them because they learned the wrong lesson.
And Trader B?
Trader B analyzed the data. They saw the fundamentals were sound. They stayed calm. They took a hit on paper for a few days. It hurt. But they followed a disciplined process. They exercised the muscle that builds long-term wealth. They are the stronger trader.
So if you panic sold this week and got lucky, you didn't win. You just survived a game of Russian roulette.
Exactly. Don't confuse luck with skill. Investigate before you conclude. That's the mantra.
Calm is non-negotiable. Action is situational. I think I'm going to print that out and take it to my monitor before the next crash. It feels like good life advice, not just trading advice.
It's the only way to survive the game.
We'll be keeping an eye on that May deadline for you so you don't have to. Thanks for listening to this deep dive. See you next time.
Stay calm out there.